We're just past the halfway mark of the year, but it's quickly becoming a record year for new covered call ETF releases. Hamilton has just released a new lineup of ETFs that piqued a lot of interest from passive income investors. So in this video, I'll go over in as much detail as I can on the DayMax ETFs and help you decide if these are going to be good additions to your portfolios or how they might fit into your current portfolio mix. These are definitely a unique twist to the zero-DTE option strategy and have a different mix of underlying holdings that you should be aware of before jumping in. Before we start, I just want to mention the membership badges have been enabled on the channel. Currently, there are just a few perks to start, but over time I'll look to add to it with your feedback on what you might be interested to see. Also, I had set a subscriber goal of 2,000 subscribers back in March, when we were only at 1,000 subscribers. Fast forward to today, we are now less than 100 subscribers away from that goal with 5 months left in the year. Hopefully we can reach that goal with this video, and as a stretch goal, aim for 3,000 subscribers by the end of the year. If you have others who would also be interested in learning about these ETFs, make sure to share with them after watching the video. Now let's get into the details for these new DayMax ETFs. Starting here on the website, we can see that all these DayMax ETFs are now available for trading and will be listed on the CBOE exchange. So the DayMax ETFs are Canada's first suite of ETFs designed to generate tax-efficient income using daily option strategies. By writing call options that expire the same day, DayMax ETFs aim to deliver high and more frequent income, enhanced by modest 25% leverage and backed by diversified equity exposure. So there are a few things to unpack here, and I think this graphic from the website showcases the strategy the best. I'll first start with the daily zero-DTE option strategy, where it says here they are selling call options every day to generate income. So you might be asking, what is a zero-DTE or zero-days-to-expiry option? This means that at the beginning of every single trading day, they will sell call options on a portion of their underlying holdings that will then expire at the end of the day. By doing this, they are able to capture the premium from the intraday volatility each day, which is then eventually paid out to shareholders. And for it to be a covered call, they'll need to own the underlying holding for it to work. Since zero-DTE options are currently available only on the US indexes, all three of the DayMax ETFs will hold a portion of their holdings in VOO, which is the S&P 500, or QQQM, which is the Nasdaq index. That is why for CDAY, you will see VOO listed in its holdings, instead of the TSX index in order to sell the zero-DTE call options. And because all these options expire or cash settle by the end of the day, it then leads us to the next part of the strategy, and that is the overnight exposure. By having no options held throughout the overnight session, this leaves the VOO and QQQM portion of the portfolio available to participate fully in the overnight market movements. Why is it that this is a notable part of the strategy is due to the studies that have shown the overnight session being where meaningful portions of the returns are made, and can be a valuable contribution to long-term performance. So the implementation of this will potentially capture more of the market gains, as during this time there will not be any options active to cap the upside. Then another big part of the strategy is the use of a flexible coverage approach. This is where it might be helpful to clear some potential confusion with the underlying holdings, and the numbers you may see from the website or online. If you look at the holdings for each of these, you'll see that it'll be 100% in a growth ETF such as CMVP, SMVP.U, or XLK. Then the other holding will be 25% in whatever I mentioned earlier, with an index position of VOO or QQQM to generate the income. So the total weight of these two added together is 125%. But in places such as the graphic I showed earlier, it says that they target only approximately 20% of the portfolio for the coverage ratio. And this is where it's being expressed or adjusted in terms of a 100% allocation amount. By doing so, the 100% is now at 80% allocation, and the other 25% is now a 20% allocation of the total amount. This 20% target for the portfolio coverage ratio now makes sense for generating the income, and then the other 80% is fully participating in the upside growth potential. Now, what does having a flexible approach to the coverage mean? This means they won't be systematically using 20% coverage constantly, but rather have it depend entirely on the volatility in the market at that point in time. So in times where there's higher volatility, they can decide to lower the coverage because they're able to receive higher options premiums. That would in turn allow for more potential upside capture in a trending market. Then in times where there is lower volatility, they can then decide to increase the coverage because the premiums during this time would be lower. That way, the distribution amounts can be maintained to the shareholders. All of this is a lot to maybe take in at once, but essentially they are actively trying to find that balance where they're able to capture the most amount of premium without giving up too much of the upside, and look to also achieve a fairly stable distribution amount to the shareholders. And to help support the stability of the distributions is this next part, and that's the growth portion of the underlying holdings. This is important to know and actually matters more than the zero-DTE options because it makes up 80% of the performance for each of the three DayMax ETFs. I'll get into more of the specifics and the actual holdings later on in the video, but here I'll talk about them in a general sense and why they were chosen. For CDAY and SDAY, we can see that they chose to go with their own Hamilton Champions ETFs in CMVP and SMVP.U. It's easy to assume that these are just the TSX and S&P 500 indexes, but this is not the case and are not designed to overlap with the other ETFs like HYLD and HDIV. What these two ETFs focus on are exposure to stable blue chip dividend companies in the case of CMVP and SMVP.U, and then a very popular technology focused index in XLK when it comes to QDAY. For the Hamilton Champions ETFs, they only hold large cap established companies that have proven track records of dividend growth and stability. So all the holdings within CMVP are Canadian dividend paying companies, with over 6 years of increasing dividends and no decreases, with an average of 10% plus annual dividend growth. Then for SMVP.U, it's similar where the holdings are US dividend paying companies, with over 25 years of increasing dividends and no decreases, with an average of 10% plus annual dividend growth. So because of these characteristics shown here, you can get a sense of how different this might look when it comes to types of companies you'll be invested in. For CMVP, the holdings might be similar to a concentrated TSX, but with SMVP.U, it's going to be excluding most, if not all, the big technology companies. What might show this better would be a sector allocation chart, and you'll see clearly that the focus is definitely on reliable dividend-paying companies with low volatility. And there are benefits to this, because as dividend payers with increasing dividends every year, it can help to naturally support or grow the distribution over time. So while the main income driver for these will be the zero DTE options, these traditional dividend companies will also contribute to the overall distributions. Now, the approach is going to be a little bit different for QDAY, because technology companies pay little to no dividends to shareholders. Instead, they have opted for a pure technology index with XLK that contains only the technology stocks in the S&P 500. You might be asking, why wouldn't they just hold a NASDAQ 100 index then? That's because within the NASDAQ 100, even though many consider it to be the technology index, it holds companies like Costco, Monster Energy, Pepsi, Starbucks, and many others which are not exactly technology focused. So by going with XLK, you're getting pure exposure to only the biggest blue chip technology companies in the US. There are some nuances though, and I'll get into that later on in the video, but for now this explains why XLK was chosen for the growth allocation. With all the more complicated parts of the ETFs explained, the remaining ones are going to be easier to go over. First, all of these will be using a modest 25% leverage like already mentioned and showcased in the holdings earlier. This is mostly for enabling an enhanced income and growth potential from the added exposure, but it's also a way to help mitigate some of the performance and bring it closer to the underlying holdings. Because when you're writing options daily, there's the potential of giving up some of the upside on a daily basis. And over time, this can accumulate or add up, so it's an attempt to achieve a balance between the two sides of income and growth. Then lastly on the graphic here is that you're paid semi-monthly or twice a month. While many of us would of course prefer weekly, but it's currently not available on the exchange level. Though when digging around the prospectus, it looks like the door is open in the future should this change and become available. So we'll just have to see if and when this happens. As for the distribution amounts, they can vary depending on the volatility or the market environment. Even though they will do what they can to maintain stability, ultimately it comes down to the premiums they can extract from the market volatility. But to start at inception, all of these will launch at a price of $24. So for CDAY and SDAY, they will both be at 18-cent distribution, giving them an 18% yield at inception. Then for QDAY, it will be a 20-cent distribution, giving it a 20% yield at inception. So to summarize everything with a few extra details, the DayMax lineup will consist of 3 ETFs. CDAY, which is the Hamilton Enhanced Canadian Equity DayMax ETF, SDAY, which is the Hamilton Enhanced US Equity DayMax ETF, and QDAY, which is the Hamilton Enhanced Technology DayMax ETF. For CDAY, it'll consist of 80% CMVP and then 20% VOO. For SDAY, it'll consist of 80% SMVP.U and then 20% VOO. Then for QDAY, it'll consist of 80% XLK and then 20% QQQM. The rest of the following details will then be the same across all 3 ETFs. So these will all use 25% leverage, have flexible coverage and overnight exposure, pay semi-monthly distributions, are unhedged, have semi-annual rebalancing, and finally a 0.85% management fee. Okay, I think that covers a summary of the DayMax strategy and benefits. Next, I'll go over a deeper look into the actual holdings and provide some more context to what it is you'll have exposure to when you buy into these ETFs. So as I've already quickly mentioned in the last section, there are many who are seeing these as index replacements for their portfolios and have started switching without fully understanding the differences. This is far from the case with all of these, and here we'll go over the exact companies and stocks you'll be investing in or be exposed to. Starting with CDAY, this is the Canadian DayMax ETF, so you would assume that it is a replacement for the TS660, right? Well, what we need to do is look at what CMVP holds and then do a comparison to see how many of the holdings are actually in the TS660. The easiest way to see this would be to look at the website and see exactly how many companies they actually hold. By adding all of these up, you'll notice that there are only 25 companies in CMVP, whereas the TSX 60 holds a total of 60 companies. And actually, one of these is not even in the TSX 60, so it's actually 24 companies out of the 60. Doing some simple math, if we were to divide 24 by 60, we will only get 40%. So if you're buying CDAY thinking you'll get exposure to the full TSX 60, this is not the case, and it should instead be seen more as a concentrated selection. This isn't a bad thing though, as these are many of the stable blue chip dividend paying companies that represent most of the Canadian economy anyways. But just know there are quite a few notable exclusions, especially in the already limited Canadian technology sector, such as Constellation Software and Shopify. Next, we can take a look at SDAY and what it holds in SMVP.U. Now, many investors are likening this to investing in the S&P 500 as a comparison, but this is one where you really can't compare it to an index at all. If we do the same thing as CMVP and count how many companies SMVP.U holds, it comes to a total of 35 holdings. You won't even need to do the math to know that it is far less than the 500 companies that the S&P 500 holds. But if we were to go ahead and divide 35 by 500, we would only get 7%. So when investing into SDAY, you have to know that it's only going to be a select few of the blue chip dividend growth companies and not the entire index. If I bring back up the sector allocation chart from the website, you'll see that it's heavily weighted in the first three sectors, in consumer staples, industrials, and healthcare. These three together make up 54% of the allocation, whereas the technology companies only make up 6.2% of the allocation. So with this mix, I would say that it would be wrong in replacing an S&P 500 index ETF like HYLD or USCL with SDAY, and that this could be seen more as a complement to those already existing ETFs. If I bring up HYLD's sector allocation next to it, you'll see the contrast in composition. So if you're using SDAY as a replacement for your US exposure, just be aware that you're giving up basically all the technology exposure, and will likely lag behind in performance comparisons to the index. That being said, if you already have a technology-heavy portfolio, adding something like SDAY would definitely help provide some much-needed diversification, because there won't be many overlaps in technology holdings. One thing to point out though, if you're going to pair SDAY with one of these and would like to maintain the hedging aspect, then going with USCL might be the better option, because HYLD is hedged to the Canadian dollar. Now lastly, we'll go over QDAY, which can be seen as a focused pure play on technology like I mentioned earlier on in the video. With holding XLK for its growth portion, we can see that the ETF holds 68 total companies. The closest index comparison would be the Nasdaq 100, which holds 100 companies within it. Of these 100 companies, only 31 of them overlap with the holdings in XLK, so that only covers 31% of the index. This makes sense because of how only a selection of the holdings within the Nasdaq are actually considered technology. So outside of the 31 mutual holdings, XLK instead holds an additional 37 companies that are actually technology focused. But if we take a closer look into the holdings, you'll notice that it's actually missing some really big names like Amazon, Google, and Meta, which many of us would consider as technology companies. So this here would require some further understanding on how companies are classified, which I'll quickly summarize now. If we were to head to the MSCI website and go under indexes, there's something called the Global Industry Classification Standard, or GICS for short. What this is a standardized global definition of companies based on specific tiers and their principal business activity. It's because of this that we see some companies classified differently compared to what we may have thought otherwise. So below are some companies that are generally considered to be technology and are included in the Nasdaq, but are actually not held in XLK because of this classification standard. As you can see, those are some big emissions, and are companies that are typically large core positions in the indexes like the S&P 500 and the Nasdaq. Some of the other notable companies that are also not held in XLK are these ones as well. In total, shown here are 9 top companies with high growth potential across various sectors. And can you guess where you could get exposure to all these, along with another 6 companies that are already in XLK? If you guessed HHIS, then you'd be correct. So similarly to how SDAY could be a complement to HYLD or USCL, you could say the same here, where HHIS could be a complement to QDAY, because 9 out of the 15 holdings are not held in XLK. There would be some overlap with the other 6 holdings though, so that's just something to keep in mind. Both of these are also unhedged, so that pairs these two even better. So all these observations are just something to be aware of, and many won't dig deep enough into the holdings to discover these differences. I would have to give it to Hamilton ETFs for brainstorming and releasing such unique products, which are so different yet complementary to the others already out there. So if you enjoyed this and found it helpful, consider becoming a member of the channel and subscribing for future videos. These videos take a long time to make, and would go a long way in helping me continue to create quality content for everyone. Also feel free to share this with anyone you know who would also be interested in any of these ETFs. A big thank you to those who have already subscribed, and with that, I'll see you in the next video.